Welcome back. Well, we've had a few earnings results this week to start the third quarter earnings season. Q3 earnings will really get underway in full force starting next week, starting with the big U.S. banks. Let's get some perspective on that from Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management. Good to have you today, sir. Thanks for taking the time.
Thank you.
Okay, so bank earnings start next Tuesday. What kinds of things are you going to be watching for next week?
Well, obviously, with the U.S. government shut down, we're not getting the regular flow of data that we're used to for U.S. markets. And so the bank executives and their commentary might be a little bit more of a parable for the health of the U.S. consumer and also the U.S. economy. So their comments are going to be very important coming through this earnings season. Our expectations are pretty high. We saw last quarter large U.S. banks do very well in a number of different areas. And that's one of the reasons we like this sector so much, is that you're finding earnings growth of roughly 12 to 13% over the next year or two. That's the only place we're finding comparables to the technology sector, but the valuations are so much better, maybe even half of what you're finding in those big tech names. So when we look at some of these names like JP Morgan, currently trading at a PE of roughly 16 or slightly below, compared to the tech sector, now you're finding earnings growth, momentum, and a good valuation with a solid backdrop. This is one of the reasons we like this sector so much at this moment, but also the importance of it, the weight that they're going to be able to provide in the moment about where the health of the U.S. economy is. And obviously, that's a big impact globally. We'll have some really good takeaways from the earnings that we get early next week.
Okay, so you do think that the earnings will give some idea as to what's happening with the U.S. economy? Because obviously, as you mentioned, the U.S. government shutdown's continuing. We're not getting a lot of that data that we usually would get this time of year.
Absolutely. We're going to get some great commentary. I mean, Jamie Dimon has already come out and said that he expects maybe that this market might be a little bit overvalued at this moment, but we'll be able to dig into some of the details as to why he might feel that way when we get the earnings. Is there something that's telling him that? Are we seeing a material rise in something like foreclosures or people not making credit card payments on time, things of that nature that might lead him to make those comments are going to be influential to how markets feel about the economy. We know that we've had some very large revisions to the labor data that make us feel a little bit uneasy about where we thought we were, at least from the last 6 months ago. So looking at that perspective, taking it forward into where we think rates are going to be going and what the health of the economy is will be a big driver if this market rally can continue.
Okay, so let's get some predictions from you in terms of what we might see from some of the banks starting on Tuesday. Do you think loan demand has increased at all for any of the big banks?
In the very near term, yes. Over the last several weeks, we have seen mortgage rate demand go up substantially. Mortgage rates here for the 30-year fixed are down around 30 basis points after the Fed cut rates a few weeks ago. And so we have seen at least measurable increase in demand that way. We would obviously expect more demand if we got another rate cut at the end of this month.
In the last quarter, some of the banks were reporting loan delinquencies. Do you think we're still going to see that as a headwind this time around?
I do think that there should be some type of an uptick. We have seen really the states that have been impacted by higher insurance costs are also reporting higher delinquencies. So more around the total cost of that payment, not just the mortgage side of it, but also when you talk about the insurance costs, we're starting to see a little bit of a crack showing up there in increased foreclosures in those types of states. Is it enough to make us really worried about the broader economy? No, not yet, but it is something that we want to pay attention to. If there is a measurable increase outside of those areas, we want to pay attention to that.
You touched on this already, I think, but do you think there's going to be an increase in investment in banking?
Yeah, I do expect that given the all-time highs that we've seen here in the U.S. markets, that there is going to be more fee revenue generation from the trading desks. We've obviously seen a lot of product innovation when it comes to leveraged products. Those are really good revenue sources for some of these large banks, just in terms of the clearing and the custody and the fee generation that they can operate from in those environments. So we do expect a robust, strong result from these larger banks over the next week or so. But we also want to see what their forecast is going forward. We expect them to play a major role in the financing of this AI build-out. Data centers are very large construction projects, and they do require a heavy amount of financing. We want to know that they're going to participate in that and that they see those projects actually carrying through, and that will be important to growth into the next year or two.
Okay, let's talk about some of the big ones that are going to be taking the lead on Tuesday. So that's Citi, Wells Fargo, and Goldman Sachs. What are your thoughts on those three banks in particular?
Well, in particular, Wells Fargo has done a great job over the last 3 years recovering, one, their reputation in particular, but two, now they've been able to participate with their asset cap removed. They're able to jump out there and be really involved. They've always been strong in the mortgage market, but now they're starting to participate in more of the IB and the trading market. Their wealth management arm growing at a very nice rate as well. So that's a company that we really feel strong that will do well in the next year or two. The same thing with Goldman Sachs. Again, we would expect them to be a major player in the AI financing. We've started to see them participate in some of the secondary financing of these AI startups that have done very well. So IB fee generation from them, I think, is going to be a key component of their future growth as well.
If the banks do well, which you are predicting, many are predicting they will, could that maybe persuade investors to kind of look beyond AI, right? Like so many people investing in AI and big tech right now and focus maybe more on the financial sector.
Well, I don't know if it will, but I think it should. And again, what it really comes down to is just the pure valuation. When you're looking at the NASDAQ trading at 35 to 38 times in terms of a valuation, when you can come back into financial services, which is a little bit of a boring sector, I get it. These are just big banks and nobody really likes bankers. But when you look at the revenue generation that's translating into real profit growth and the valuation that you can buy into right now, the whole sector being valued around 15 to 16 times earnings, this is a much better place per unit of risk to invest new money today versus chasing an already perhaps maybe even overheated sector in that AI momentum trade.
Okay, we'll have to see what Tuesday brings. That was Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management. Thanks so much for joining us today.